All right, everybody, welcome. Happy Wednesday, April 24th. We hope you're well wherever you may be in this world. We'd like to welcome you to our monthly jobs report and inflation update. My name is Albert Chen. I'm your host, founder of Albert's List, and I'm here with my two trusty co-hosts, Colin Moe, who's a community moderator, and Dr. Riley White, who is associate professor of finance at the University of New Mexico. Uh, at the University of New Mexico. On a monthly basis, we gather here to talk about the state of the economy, the state of the job market, all of the trends, including inflation that impact it, and how it is directly tied to your job search. And so, with us, as mentioned, is Dr. Riley White, who is a well-known and also very qualified individual to speak about all these topics. We'll be sharing his LinkedIn shortly in the webinar chat, so you can see what he's all about and go from there. Without further ado, I'm going to go ahead and hand it over to Dr. White. One more thing, this webinar is being recorded, and if you do have any questions, please drop them in the webinar chat, or if you're watching on Facebook, drop them in the Facebook comments, and I will try to get to them. All right, without further ado, Dr. White, hello and welcome back.
Thank you so much, Albert. Thank you so much, Colin. And of course, welcome Albert's List and happy Wednesday. It is so great that you all are spending this wonderful evening hour delaying your evening meal to spend time listening, watching, or otherwise operating heavy machinery and listening to this digital event. So my name is Riley White. I'm very excited to talk to you about some economic data, economic things that are going through. It is great to see Aaron in the audience. I know we've got a few people that I know from before who've attended. If this is your first adventure, please never hesitate to reach out directly with questions, either through the Q&A or directly in the chat. I am honored to connect with everybody. Albert's dropping my LinkedIn as well. Please feel free. Never hesitate to reach out and connect. It is a great delight. So let's rock and roll. And I got some shenanigans here. I prepared our report today. I had a radio interview today about the state of the economy, really just transcending media on days like this. But anyway, we've got this. I've got our official AI generated Albert's List cover. Everything looks like a B-level barbecue joint. But our March 2024 jobs report, I am the Associate Dean and Associate Professor of Finance at UNM Anderson School of Management, an AACSB accredited institution, and the second best Anderson School of Management in the country, to my knowledge. Now, when we head about, let's talk about some things, what's happening, what's going on. The prompt was, that's really good. Albert says, what's the prompt for the unicorn image? I just have to say Albert's List, and that's all it needed. It's just AI knows intuitively what Albert's List, what's meaningful for Albert's List. An Instagram star. If not a star, maybe another shape, like a rhombus or a square. But on this March 2024 jobs report, we actually had a very solid jobs report. We're going to talk about inflation. We're going to talk about a few other things. Some of you reached out with questions about the jobs report, about the presidential election. We'll go into a little bit more details about what that's going to do. Sean reached out about the equity risk premium. We got questions from Colin about inflation, the macro situation. How do people insulate themselves from the never-ending march of higher prices? And we'll talk about those things today as well. So our jobs report that was released a couple weeks back for March in April was very solid. We added over 300,000 new jobs, and unemployment fell slightly to about 3.8%. Now, those of you, if you think about the United States in the long run, 3.8% is very good. It's very near what we call full employment. But one question remains. Is 300,000 jobs, what does that mean? Is that a good number or is that a bad number? And one of the things we have to think about when we consider that is we have to think about the assumptions that go into that. $300,000 is a great number if we have a low immigration economy, like we did when immigration dropped off in the 4 years or so prior to COVID. because immigration has picked up drastically, and because the Economic Policy Institute ran some numbers 2 months ago, and they found that maybe 50% of the job increases we've seen in the last year have been due to the increased immigration, which is a net good for the economy. We're seeing actually 300,000 is kind of okay. It's a okay number for an economy that's absorbing people, that's growing, that's developing in different ways. Of note, always a question about workforce participation. We have about 80.7% of prime working age population currently employed. The prime working age is 25 to 54. Still a demographic that I fall into. You might find yourself in that demographic as well. And what this is this is considered, this is sort of after you're a college student, before you retire or retire early or retire and when you live up in Napa and own your own vineyard, and whatever that is and whatever age that happens at. That's the kind of age that often drives what we consider core economic growth. And so far, this number, 80.7%, is consistent with other highs that we've seen in the economy over the last 30 years. It is excellent. Now, we have a few other things to note. Where were jobs added? So you'll notice that in this graph on the right, we've got a whole bunch of places that added jobs. We've got healthcare, always coming out as number one recently. We're getting older. Healthcare, the healthcare, I age 3 months for every month at Albert's list. I age 3 months for every hour I spend in Albert's list. No, I'm just kidding. No, but healthcare is a solid industry in both good times and bad times. It's considered one of the, in some aspects, for some critical care, it's considered recession proof. And so it's an important thing to consider, especially as you look at this, that in the last few months, especially, healthcare has been dominating new hires. Leisure and hospitality coming back fast from COVID-19. Now it's more people employed there than we actually saw pre-pandemic. The government employment is up 71,000 this month. That is significant. Government employment can be for a number of things. Separating out from educational services, it can also be education, it can be other aspects of government. But also of note, I want to point out construction specifically. Construction shows, is there building going on in the economy? Are we doing stuff to create stuff? And the addition of construction jobs shows an optimism, despite higher interest rates, that the economy might continue to do well. So Albert, oh, that's right. This is very good. So Albert has a note in here. As I mentioned in the Facebook group, I felt like most of the jobs were created were government tangential, a result of government spending. That's right. And so that was a big impact. We added about $5 trillion of COVID-19 stimulus spending into the economy, almost a quarter of our GDP at that time. And as a consequence, that had the benefit of giving a lot of money being thrown around the system, and that did help us recover at a much speedier rate than other countries. Ross points out most jobs added in the service sector. Absolutely true. Albert says, I expect that healthcare to drop off in 15 years as boomers pass. That's interesting, Albert. That's a good perspective. So you can look at it from the generational perspective, that this generation of boomers is going to retire. But at the same time, looking at, say, a population pyramid, it might actually continue to be a healthcare dominant industry, only because the proportion of our country's population that happens to be old is still going to be really, really high. It's not being replaced by a sudden younger, lively generation. We're not having a lot of kids anywhere in the developed world. And that's a really, really interesting, it'll be interesting to see how that falls out. Does construction hiring, Albert asks, come as a result of Build Back Better legislation? It is not affected by Build Back Better legislation, and it depends where. So we've seen different aspects of construction have behaved differently. We saw a couple years back a surge in multifamily housing. We saw around the country, rates were low. People needed places to rent because they couldn't afford homes, and they still can't. And so we surged in multifamily housing. That's since dropped off a bit in aggregate. There is a lot of attention on single family houses and builds, and that amount has been consistent in some metropolitan areas, but it's not at a level that is necessarily where we even want it to be. And then on the other side of that comes commercial, which I'd separate into good commercial that's performing well and expanding. It could be Build Back Better. It could be also infrastructure based. A lot of the manufacturing legislation and things like the CHIPS Act, we're seeing investment in places and in factories that we haven't seen before. All of this is driving construction spending even higher. Wholesale trade's okay. Financial activity is disappointing. And there you got right there the information sector, the bread and butter of the Bay Area itself, with a solid 0.0 ad. Maybe it was a job added. Maybe it was a job lost. Who knows? But this is a challenging environment for information. We'll get into that in a second. Labor force participation across the country stands at 62.7%. But Riley, what is the difference between prime working age population and labor force participation? Prime working age only looks at 25 to 54. What labor force participation is this takes the total number of people who are working divided by the working age population, and that's of a much broader area, 15 to 64 typically. So basically the entire rough lifetime of folks in the labor market. That number has come down pretty consistently in the last 20 years or so. Ross says, AI replacing knowledge workers. Part one, dun, dun, dun. It's interesting economy too. It'll be an interesting, is AI replacing it? Is it a result of overhiring in the pandemic because of planning? Is it higher interest rates? It's probably all of these things. Monthly wage growth was about 0.3%, which is okay. Over the last year, we've gone up about 4.1%. Noted that this qualifies now as real wage growth because it's wage growth that's higher than inflation. And so our bottom lines are increasing. If this can be maintained over a long period of time, this will be an engine for economic growth. This will allow people to potentially save and get ahead on bills. We just haven't seen that really in the credit quality right now. I am waiting for it, though, and optimistic, more optimistic than before that it'll happen. And Aaron has always called it. Aaron's been gangbusters for the economy for the last year or so. So credit where credit's due. Aaron might be right about the whole thing. Aaron says 1.5 years more in 2025 to 54, but still part of 16 to 64. Yeah, as part of you have a job and you're age 1 to 99, you're part of the grand labor force, Aaron. That's going to be great. That's great. 1.5 years. We're going to celebrate, Aaron, on Albert's list when you graduate the prime working age area and you become, that's going to be great. We'll have a big party. You're going to drop off and we're going to notice that in the numbers. So real wages are rising as prices decelerate faster than nominal wage growth. In other words, prices are price increases, inflation, CPI, that's been slowing down. It's still high in the sense that when people think of growth in prices, they're not just looking back to the horizon that me and every other finance and economist person will quote. They're going back 3 years. People's horizons show a significant change over time. And I'll demonstrate that in a chart coming up too. So it's perfectly fine, perfectly reasonable to still feel like you're paying just incredible sums of money for what you're buying, even though you see on paper the inflation rate has been low. You're seeing compounded effects of year on year higher than anticipated inflation. So Ross says, yes, Albert says he's going to get us welcome to the AARP packet soon. Albert's List has their own. Albert's the Albert's List Association of Retired Persons. Ross says, layoffs are usually corporate greed, rates, access, hiring are excuses. They need their third yacht. Aaron says, I want to work forever to the last breath. Want to send my XLS, my Excel, and send my last email out as my final EKG alert. What will be in that final .xls file? Send it as a CSV and be really annoying for the people going forward, Aaron. Just really bring it back. Dig out Lotus 123. Send that mofo out. So on this one, real wage. So what we've seen in this graph here, nominal wage growth, what we actually see in the wage numbers is the dark blue line, the medium blue line. And I do apologize to anybody who's in a colorblind spectrum on this, and they're looking at blues and other colors and shades. And I know this is not the clearest chart for this. The Economic Policy Institute does a magnificent job in their analyses. But real wage growth, which is net of inflation, is this line here, which is this bottom line, this middle blue line. I don't even know. I don't have too many words for blue. This real wage growth is lower, and we just crossed into the positive territory at about 1 year ago. And since then, we've remained in the positive territory for wage growth. And we had this 2 year period where inflation exceeded wage growth, and people's purchasing power shrank. And we are still feeling the effects of that. And if we look at a line and we connect where real wage growth should be, we're still falling a little bit below. And that's why we feel poorer in a lot of situations like right now. And this is really interesting. So where did we see wage growth during the pandemic, the last 4 years? One good thing to come out of this last 4 year puzzle is we saw lower wage workers in particular. They had the strongest wage growth during the pandemic. We've seen, although we are still a very unequal country, we saw a slight decline in our relative inequality as measured by the Gini coefficient. And some of this is due to the fact that we've seen greater demand for low wage workers, service sector workers, other workers due to labor shortages, due to millions of people going unemployed, people who left the job market or had to leave their jobs. Weren't waiting around until after the pandemic for that service sector job to come back. Employers struggled to find people to fill those roles. And the good news is they've finally been able to do so meaningfully in some capacity, but with higher wages. Whether this can be continued over a long run, that's a really open question. Aaron says he wants to work forever. That's right. I love that. I love that one. Still low by historical standards. Unemployment rate 1948 to 2024, 3.8% across the country. That's about as good as it gets in a Jack Nicholson sort of film way. But we have this tendency to consider anything kind of around 4% or lower as being what we call full. Oh my God, Aaron, I'm going to send that link out in 1 second as well. So hold on, hold your horses. We're going to introduce that. I actually I take some of those slides out here. So those of you who don't know, and I'll send this link again, take a look at this link. This is going to help us out for like the next 3 slides. This is done by Joe Politano's analysis. And we have some of that here. I'm a subscriber to Aprecitas, the economics site that he has here, and it's really a fantastic read most of the time. And he goes into detail on the tech area in San Francisco. Check out this link, take a look at it, and it is fascinating. Albert's like, how concerned should everyone be about this? Fairly, but I'll explain in a second. That's a good question. So unemployment's low. We're still good, but that doesn't mean that individual industries still aren't suffering in various ways. It doesn't mean that you are in an unusual position because you're having trouble necessarily finding a job. Sector by sector, it varies substantially. But some good news first before we get into the challenging news. So if we look at our GDP per capita growth in the G7, so this is the 7 large industrial Western nations: United States, Canada, France, Germany, Italy, the UK, and Japan. We saw Japan slide into a recession. We saw the UK slide into a recession. We saw Canada kind of slide into a recession. But look at the United States. Sunshine, rainbows, unicorns. We just keep trucking. Spend lots of money after the COVID pandemic. We're just rocking and rolling. We're just going gangbusters out there. It's just amazing to see our economic potential realized. Russ says, how much of USA GDP is war spending? Oh my goodness. There's an interesting question about this. We're actually studying, I'm one of the articles I'm working on with one of my colleagues, studies defense spending in relationship with actual technological growth and technological achievement. And so it's a really interesting relationship over the last 70 years. But war spending, and this is the other thing, and not just war spending at all. We're running a huge budget deficit. We are spending more than we're taking in tax dollars. Global military spending last year hit a record high of $2.4 trillion. I feel like we're around 700 billion or 800 billion of that amount. And that's direct spending from the government. And then, of course, there's all these affiliated industries. And so there's a lot of that goes into this economy. And so looking at it this way, one could argue if we divide by the size of the economy, it's like, oh gosh, 4%, 3%, 4% of the economy. It's sizable beans for sure. It's a big deal. It's a big deal. It's a fascinating, and it's terrible. It's just something to examine within details. But we'll talk about that too. This is we go not this week, but if you have questions about this too, we can also consider that in future sessions too, especially as this research revolves. Anyway, but one of the things that I also want to note too is that your non-farm payrolls across the country since 2020, although the economy has been doing great, it's not very even. Everything in red, and this is a Joe Politano chart, everything in red is negative. Meaning that there are fewer people working in these states than where they were in January of 2020. Everything in blue, although the color scheme suggests blue is sad, blue is really good. Blue suggests this is a huge growth in payrolls, so above 6%. And then you've got everything in the middle. Here we have California, New Mexico, delightfully bringing up the mediocre center. California adding about 1.9% to payroll since January 2020. New Mexico about 2.5%, but a slew of Western states hitting the 8, 10, 11, 12% value in the size of the growth rate they've experienced. But it's very uneven is the picture that I want to predict. I want to show you here. R. White L at L Citation. Yes, I want to thank Albert's List in particular for their excellent work in helping me verify and validate my research. What kind of jobs can we find in New Mexico? I just talked about that today. I was on a radio station. We got cowboys, we have cow people, we have all kinds of, if cow prefaces, we have cow doctors, any manner of these things. We're like the sixth or fifth or sixth biggest dairy state. Just all manner of cows, lots of open land, it's really good. And Aaron, this is good too. And note, Aaron points out the defense multiplier is rocking. One thing so what Aaron's talking about here is different economic industries have what's called multiplier effects. That is, in simple terms, an investment in this area, this district, this industry produces a outcome that is 2, 4, 8, 10 times better. And defense can be positive around these as well. N equals 49,500. Yes, every Albert's List person is a unsolicited data point. That's really fun. So it's mediocre, and it depends on where you are in this industry. New Mexico is a fascinating state, by the way. We have of course Sandia National Labs is here, and Los Alamos National Labs, but also a mixture of other things. We have second biggest oil producing state in the country. Go and figure that. It's giving us a surplus to enable professors like myself to teach audiences in New Mexico without the constant fear of budget cuts that exist in other states, which is very grateful for that right now. What's going on in the Virgin Islands? 10.8% decline, and also a 4% decline in Hawaii. That's a really good question. Does anyone have a quick answer for the Virgin Islands economic breakdown? Some of that I suspect is related to tourism. I would suspect that that's gone down a little bit, given that it's such a dominant. About 60% of the Virgin Islands GDP is related directly to the tourism industry. So I suspect that the fall off has never quite fully recovered in those areas, and that's some of them, given the financial challenges. And I know there's some other things. Yes, that's a good question. Why South Dakota and not North? North Dakota is interesting. So South Dakota's benefited from like normal Western state stuff. North Dakota has energy, but the energy production's fallen off a bit, which is interesting. And I only know that because we're falling off the Bracken oil fields have been underperforming the Permian Basin oil fields in New Mexico. And in New Mexico, we've actually increased our oil production tenfold since 2010. Go and figure that one. And it's a fascinating debate as to how to convert that money in a petro state into something that's sustainable, that involves clean energy and is something that can actually generate economic growth. But, we do rank 51st in education, but that's why we're here. So Albert says, Idaho is really producing potatoes. I visited the Potato Museum. I took a trip. I took my family up there. And I said, you know what you all need to see? We got to visit the Potato Museum in Idaho. So we drove up there from our humble abode in New Mexico, all the way to the Potato Museum, which is located in, Blackfoot, Idaho. Excellent. Just a gigantic potato. Highly recommended if you're traveling to these areas. Aaron says, I go to the U.S. Virgin Islands in June every year after the expensive season in April. It's dirt cheap, and a baby Hawaii in the Caribbean. A baby Hawaii. Oh, so it's adorable. I love that, Aaron. That's good. It's good to have a vacation place. I have not been to the Virgin Islands. I'm headed to Alaska at the end of May, which is my 50th state, and I'm looking forward to that. and then I'll have everything, and then I'll be done. I can retire. Age Against the Machine. So let's talk a little bit about before my preface into the California situation. Let's talk the 50 state tour. I know. I was traveling with a friend, and I'm like, I want to go to Barrow, being I want to go to the farthest north point, and I wasn't getting a lot of enthusiasm to go there. I'm going to try my best to evaluate that and make that happen. But Age Against the Machine. So we have right now a fascinating, um, a fascinating duality in our economy with our approach to AI. We have a weakened information sector. And at the same time, AI has never been more popular in discourse. So if we look at figure 3, so when you're a company, a publicly traded company, you have an earnings call, and that's where you get on the phone. And I used to have to listen to these when I actually had a private sector job, and they're really, really boring. And I feel like every CFO ever is the most monotone human being that you can find. And you got to get on this, and it's like you answer this. You're getting on this, and it's physically a phone. It's physically a call, and you're like, and the CFO starts reading, and they say, well, we expect that by January of 2024, we're going to have an investment of about 3.7 million in so and so. And they go on and they talk like this for hours. And then you get to ask them questions. And so if you're an analyst, and I was an analyst, you get to ask them and say, what does this mean? What does this do? And why are you doing this? And what reason is, what is the meaning for this meaning? And they answer you. And we found that these are these are very useful signals to the market of what the company's thinking about. And if we look at the S&P 500 companies, the 500 largest companies in the United States, mentioning AI on earnings calls, saying that, hey, this is an investment. And even if it's a buzzword, and they're like, yes, we're considering AI for, our trucking firm. They're looking at this and they're thinking about it more often. About 20% of companies did up until 2023. ChatGPT is launched. Suddenly that number doubles overnight. And interestingly enough, one of the things to consider about any economic projection as we go forward is demographic transition. So people in their prime years, so this 18 or 25 to 54 demographic, or 18 to 64, the people who are working with the weight of the world upon them, with society's expectations just smothering them into the ground. Why don't you have 17 homes yet? Why can't you do 25 things? You're working 100-hour weeks, but you're expected to live life to the fullest. This percentage of the population is expected to drop as time goes on. And we're seeing this across every developed market, and we're seeing it big time in China. And this will continue to happen. That will change drastically our approach to a large number of things, not least healthcare and among other things. And the game of the game is, and one of the reasons that I am, as I like to drop and be like, we need a lot of immigration reform in this country. We need to do things in ways where we can bring people in easier, but also provide, very strategic ways to boost our labor force. The countries that win in immigration for working force needs in the next, 50 years are going to win the economic race, period. And if I were to adjust on anything, on any other metric, it will be that appreciation, that understanding, and that valuation. Albert says, truly a hype cycle. Did the same happen with cloud? I don't know. That's a really good question. Cloud was everything. It was, oh gosh, cloud this, cloud that. Gosh, you're right. It is, that's a memory. Oh man. Okay. So in the link shared, and I'm going to continually, if you haven't seen the link yet, I'll share it again yet another time. Aaron shared this as well. Take a look at this report. It is fascinating to read. And I do agree with the conclusion. And I'll explain kind of my view on this, as well as 3 selected slides that I wanted to talk about. And then I want to encourage you to read this and come back with other questions. And then I'll answer some of the questions that we had already on this as well. So this is really, really interesting. So, the California tech sector job growth. So tech sector, it's been rough, hasn't it been? If you're looking at this, you came out here, you got the greatest job, you studied your whole life to get this job. It's there. You find yourself in a startup, you're making money, things look good, you've got equity. The startup, something happens, you're laid off. Suddenly, you're in a position of stress, you're in a position of disdain. Albert's list, holding out their hands, help join this community. of disenfranchised tech workers in a way that can benefit the world. I'm really making this exaggerated, but so the malaise you're feeling in the employment sector is real. Since 2020, 2021, we had an explosion of interest in technology and hiring, and rates were low. And I'll explain how important that is to valuation in a second. So software publishers, computing infrastructure, computer systems design, all hired massively during this period, up until the midpoint of 2022. Then a few things happened. Inflation was high, for sure. But then we also had the Fed combat inflation by raising rates drastically. One of the interesting parts, if you ever have taken a finance class before, and you've done a valuation analysis or a free cash flow analysis or calculated the terminal value in something, you know immediately that subtle changes in your projected growth rate, how much you're going to grow over the next 10 years, or your growth rate, let's say, until the end of time. A lot of companies, when they run projections on their value, they're running projections that are based off of the idea that, hey, the next 5 years, the next 10 years, I can kind of project the growth rates. After that, I'm going to use some number, some value to project all that growth rate all the way out until the end of time. And we know companies don't last that long, but because of time value of money, because of growth rates, and because of things, we know that small changes in what we expect that growth rate to do, and what we expect that discount rate, how much we take future cash flows and value them today. When we convert a future cash flow of, say, $1,000 in 10 years, and I ask you, how much is that worth to you right now? You're not going to say 1,000. You're going to say, well, I will take $50 today for $1,000 in 10 years. What is the equivalent value? We know that the time value of money says that the value of money goes down as time goes forward. And as a consequence, when we value a company and a startup company, when rates are low and growth rates are high and discount rates are low, valuations are high. When rates go up, when the Fed raised rates to combat inflation, it made it more expensive for investors. The projects that looked good suddenly don't look good anymore because the rates don't support it. It's too expensive to build that factory, to support this investment, or to do these other things. And so then we see what happens is the company loses value. The valuation can't be supported. People pass on the investment. And in tech firms, especially in new tech firms, everyone knows this. But tech firms, because they're new and because so much of them, even the mature companies, are based off of so many potential growth strategies and market conquering ideas, they are prone more than any other industry to changes in the discount rate and changes into the financing rate. Both of those things went haywire for these companies in 2023 and 2024. They also overhired. They also were confronted by profit models that could no longer be supported by what consumers were actually doing. And so they started laying off workers. And we saw this, it's been a slide, and it started straightforward. It started easily, and then it's continuing to slide into 2024 with job losses now in aggregate among web search portals, in particular, computer systems design and streaming services. Aaron says AI is combining the business intelligence market merged with the API market and data management. Agreed. And I think that in the future, it will continue to be a big force. But the question of AI, is it nefarious or is it good? Is it a sewing machine that helps people who are able to sew, say, 3 pieces of clothing a day, hit 300 pieces of clothing? Will it make us more productive? Yes. Will it cost jobs? Also, yes. Will those jobs be made up in other areas? Typically, yes. And what is the rate of this job makeup? It'll take decades to realize its potential. Albert says, many set out west for the free lunches, masseuses, and dry cleaning, and they got laid off over Zoom. No, man, I need free dry cleaning. Ross says 0 to 1% were unusual. Average rates historically last 100 years is 5 to 6%. You're right. But the point is on this one, and that's a good observation, Ross, and I appreciate you bringing that up. But here's the thing with those rates, right? We've built an economy that's been around now for the last 15 years with near zero rates. And suddenly we raise rates. And these rates are not high by 100-year standards. But the market valuations that they're tied to are based off of 0% rates. So the fact we have housing that's really expensive, the fact we have stock prices that are very, very high or were very, very high. All of that happens in areas of 0% rate environments. And those valuations, 0% rates inflate asset prices. And when those rates increase, asset prices start going down typically. But there are frictions to that, and that's the issue. The inflation we're seeing now is a result of 0% rates. So yeah, the inflation over the long run, there's all kinds of stuff that we can get into about that too. Yeah, feeding frenzy, Albert said. Boom goes the dynamite. Now, let's bring it back to Cali. Share of US tech jobs in California. Is it catastrophic? No, but is it a trend worth watching? Absolutely. Tech jobs going elsewhere, right? Software publishers, computer systems design, web search portals. They used to be dominant in California, above 45% or almost 45%, now down to about 35%. Most of that, of course, much of that in the Bay Area. But it doesn't mean that this itself is irreversible or this itself is something that can't be beat. California always has a natural advantage, the presence of all the VC providers, all the equity capital sloshing around, and just a culture that's accustomed to building companies up in the Bay Area makes it very, very strong. However, what's a good news about California? Well, when it comes down to the pay that people get, where does compensation go in the tech sector? Still comes back to California. And it's still increasing or about increasing, about 1/3 almost of all information sector compensation comes back to California. Albert says they hear from a lot of job seekers that many general admin jobs have been outsourced abroad in this time as well. Absolutely true, too. You're seeing that across the board. Outsourcing as a business model is something that companies try periodically and inconsistently, but it is ever present and likely to be extended, particularly in certain sectors where labor costs are particularly dear, or they can't find enough people to do it. Or even then, one of the things, of course, in the Bay Area is you have a dearth of lower income and middle income folks who can afford to live there. And as a consequence, you end up in a situation where you are outsourcing a lot of those jobs as well. So what's going to reverse this thing? And Joe Politano says this at the end of this analysis, and I agree with him on this. And this is one of those things that isn't like, oh, there's a high horse. It's not really a political thing. It's people hate it on both sides. But the answer is you really got to build more houses and high-rise things and places where people can build equity in a place that they own. And it's got to be a lot different than it is now. To be frank, there is so much challenge attracting people into the Bay Area with costs as expensive as they are when they could have a choice of living in other places. This is a calculus that everyone performs when they decide and get that job offer. Is it worth moving out to and is it worth doing? So a couple of quick charts. If we look at the Federal Reserve economic data and we compare total California building permits to North Carolina, a state of 1/4 the population, you both build the same amount. And then if we look at the Bay Area, which is in blue, against Austin, boo, in red, and then Washington, D.C., an expensive market in this yellow-green color, and then pea green, and this is the hilarious part, Omaha, Nebraska. If you look at Omaha, Nebraska, compared to the Bay Area, even Omaha builds more houses, more homes, more construction than the Bay Area does. And it is not a doubt, it's fundamentally supply and demand. We could take a list, and having traveled recently to Tokyo and Osaka and then to Taipei and Taiwan as well in October, I got a sense of these things, and I think we could borrow a lot from other international cities. But one of them is, you can't. And I was signing this agreement with the president of Osaka Metropolitan University. And I asked the president, I said, so, what do students normally pay equivalent for housing in Osaka? Very large metropolitan area. It's about New York sized, in fact, as a city in Japan. And they pay about $400 a month. And you can see why. A lot of places maintain this. There's a lot of public transportation, other things, but density enables it. You can live there, you can afford there, and there can be reasons that people come there and live there and work there. Just terribly. Are California zoning laws to blame? Yes, they're terrible. I say very little things unequivocally. Normally, I try to be moderate and I try to be like, it's this and this and this. This is 100% has to be fixed. And Albert is absolutely right about this. And this analysis he's running is worth reading because we've talked about this every month. And I feel like it's a broken record. There's nothing you can do. Low income population is moving out. And it needs reform, of the CEQA, of these barriers to development that are quite real. And they're real in a lot of places. And they're really, if we consider this way, we look at the global housing market, they're highly specific to Anglophone countries. Zoning laws are by their nature exclusionary. And there are places where people said 100 years ago, this is the only type of place that I want built in this section. It's a very unnatural thing in the United States development. We were growing, building. We demolished, we built, we demolished, we built. Suddenly it's like, no, stop, stasis. We're going to have neighborhoods composed of the people that we want to surround ourselves by. And the consequence of those things is without the addition of new housing, new units, and new structures, you end up in a situation where the existing housing stock is under immense demand. And the limited supply has driven prices out of the reach of any most reasonable people in the Bay Area, save a small elite, or whether or not that you've inherited something, and no bias on if you have. I'm a poor peasant myself, but I appreciate anyone's background wherever they come from. But it is an impossible juncture to bring people here to the Bay Area when it's this expensive. So it's not enough to build affordable housing. Like I can, and this is the argument, it's not a bad idea to have government subsidized housing. You spend $4 million, you build, 10 townhomes. It's just the volume isn't enough to make a dent. And that's the issue. You need volume. You need not just 1,000 more units, not just 10,000. You need hundreds of thousands. I would even venture to say millions of more units in the Bay Area. That's what I would venture to say. Yeah. True. Julie says part of why work from home works. You don't have to live in the Bay Area. If only the CEOs of some of those companies recognize those facts. This is a fascinating part too. I'm a big fan of work from home too, Julie, and I hear you on that too. I think it's a possible thing where you can get that job and earn good money and be able to work from home efficiently. At the same time, though, we're running into these other variables. We know that people work from home, research coming out that, working from home limits certain opportunities for advancement in other places. We know that companies still have generational concerns about whether this is good or this is bad. And as a consequence, people end up being at a disadvantage in many aspects of their career. And we're trying to balance all of this. And right now I'm looking at this and I have a staff of, there's 40 or so people that work under me. And it's like, I want everyone to have at least 2 days at home, but I don't have a mechanism unless it's an extraordinary circumstance for it to be greater than 2 days. And we're stuck in these areas. And I don't know if that'll change meaningfully. So we met many webinars ago, Albert said, when Stanford, Cal, and Sand Hill Road moved to Utah, and the Bay Area may become Detroit. Do you have any of your colleagues done any work from home research, WFH research studies, Dr. White? That's a really good question. Yeah, it is a thorn in the side of the CRE bank loans. Ross is absolutely right about that. Not least because, of course, commercial real estate, looking at the vacancy rate above 25% in San Francisco, looking at some of these commercial real estate loans taking a hit because of work from home. People should have the ability to do so, and it's good for morale. My colleagues, no, I don't think that's in their side. We like more esoteric stuff. We like if it's not practical and we got something in there, we'll write about it. But there is some good research out there about this. Dell recently told workers, this is from Albert, work from home employees are ineligible for promotion. Another thing that tech workers are faced with. Do you want that ability to work from home in an area you can afford? Or do you want to be stuck in the same job in your career for the rest of your life? And it's Michael Dell just laughing from his, underground lair in Texas. And this is true. I saw this too. The 62 million San Francisco office tower Albert points to dropped to 6.5 million. Now, the new headquarters of Albert's list. It's coming down to it. Corporate headquarters. So this is a big deal. Build, build, build. You know the story. You hear it on your news all the time. It's not, people will logically, they'll they'll go to, I've had debates about this, and even people who are very open-minded about these things will just go to these, ridiculous logical places or make these incredible excuses to go around the issue of just, building more. And it would help. And that's huge. Oh, the Riley conference room. I would love a conference room named after me where people can while away watching the clock for a meeting to end. That's really the value my life represents. Julie says in tech, everyone job hops to get more pay. They don't wait and beg for promotions. Also true too, Julie. I appreciate that as well. And this is true. And I think it's worth trying to do and work from home. It can be limiting for some people some of the time. And I want that to change. I want to stay to a position where that is no longer a relevancy. And I think improved communication, other things will help that, but it is a riot. Aaron says California needs new super city regions built around college university towns. Boom. That'd be awesome. Ross says, and the banks who have investment stocks, board seats in the companies are telling the CEOs to get rid of work from home. Absolutely. Everybody's connected. Albert says, just a few more years and we'll create the Riley White Economic Scholarship. I hope not. That implies my death, probably. No, they won't do it. No one will pay for no one. It's fine. My memory is, people worry about legacy and naming things after them. It's really fun. My long-term goal, Albert, if I'll be frank, I want to bury myself in this, like a Neolithic style tomb somewhere out in the desert. And then I hope that some future generation, thousands of years hence digs this up and thinks, I'll write some false autobiography. I'll be like the King of Kings. And it'll be like this really long, extended biography that exacerbates and makes, really exaggerates, I should say, my accomplishments. And then, some future generation is tricked because they think I'm a valuable person and they bring me back to life or clone me using technology. And then my clone will undermine their civilization with my incompetence at some point in the future. So it's a long game. So my 5,000-year plan, and that's what it's going to be. Melanie says we could have the Riley White conference room mausoleum, like just my petrified waxed body just on display, my pallid and demeanor. That's great, Melanie. Thank you. I'll have nightmares about that. That'll be good. It'll be good. I appreciate this, and you guys are amazing. You guys are all amazing here for even being here. So thank you for rocking and rolling. And please encourage your legislators to build more houses, please, for everybody's sake. Just build houses. I think about this. One of my greatest family stories. I had a great aunt who lived in Atherton. They're just regular human beings. She was just a person. She lived in Atherton. Can't do that now. Albert says Dr. White's red book with economic sayings featuring inflation is only transitory. It was. Oh, but can we get out of it? And I love that lead in, Albert, because look at this. Let's have a little bit about inflation. Actually, and let me do this first. Let me get back to some of the questions here that were relevant to this. We got some elections. We're going to talk about that. I got some elections, and that's good. We got industry questions. I left those slides further down. We will talk about inflation. Shelter. Oh, man. Up 5.7% in the last year. Rents are sticky. Rents are going down. Shelter is still decreasing year on year from where it was at the beginning of the year, but it's still year on year 5.7% increases. And even though we've added all this, say, rent capacity, shelter capacity, there's a lot of frictions, a lot of barriers that keep people from moving always to where there are cheaper rates. People don't want to move. Rents happen, and when good deals happen and when people are locked into a rate, there's always a friction involving, whether people move or not, whether people have access to other homes, and whether or not they can negotiate a superior rate. But in general, it is headed in the right direction. Transportation services, 10.7%. 10.7%. Up in the last year. That is highly significant. Transportation services can refer to shipping anything, but also just simply, we are dealing with high demand and tight capacity. Our economy is doing well. There's a lot of demand, and there isn't enough stuff floating around here. Restaurants. We also have auto insurance rates that are going up at a 22% clip over the last year, including a 2.6% increase in March. So when you were trying to renegotiate your automotive insurance and you got that bill and you're just like, this can't be right. I didn't get any tickets last year. That's exactly why. Shelter is up. Restaurants. Labor costs are up, and those labor costs and food away from home is up about 4.2%. Oh, got some questions here too. Ross says legislators, best investment money can buy. They don't work for the populace. Oh, goodness, ain't that the truth? Albert says, question from Anonymous. What type of jobs are out there for people outside the prime working age? That's a really good question, Albert. So Albert's list anonymous attendee. Consulting. If you're above, it depends if you look at that question, you say below 25 or above 54. So above 54, you are seeing an increased demand for older workers in the marketplace, for their expertise, for their abilities. As Russ pointed out, I consulted actually an organization that serves retirees. And these retirees were starting second careers, third careers. And they were going about this and they're getting demands there. So anything where they possess expertise, when you're older, to Ross's point, it is stuff like consulting. It might be taking on other demands. Often people are hesitant at that age to take on educational or job training skills, but using the skills they've already done, there's a lot of openings. Below 25, it gets trickier because what we found, even though the minimum wage increases are good generally over the overall population, where we do find job losses when the minimum wage rises, job losses occur particularly in teenagers, because if companies have a choice, they'll not hire a teenager versus hiring a teenager if they have to pay a higher wage. And so we see some service sector jobs in particular, and for the 25 and under crowd, it depends entirely on the skills that you can bring to the table. Aaron says, I want to have the Heckscher Oldham trade theory on my gravestone. Wow, that's a fantastically nerdy reference. I love that. So this is really good. So those of you who don't know, it's one of our key equilibrium trade models in economics. If we had the Aaron Fed call last year, I would have raised rates to 6.5%. Aaron, and this is the funny part about this. As you can see from this chart, you might have been right. And I'm going to go into this soon. This is all about Riley admitting Aaron was right all along. Albert says, is ageism a thing, though? Do you ever see ageism in the charts? Good question. Ageism always might be a thing. It might very well be a thing. It's certainly a protected thing and something people to be concerned about. I suspect anyone who's been on that side of things, and the 40 and over crowd in particular, you've had positions in your life or positions where somebody has hesitated and they've made a comment or made a gesture or made an indication that something may not be suitable for you because of your perceived age. And so I think it does happen a lot. But I think there is hesitation. I think people by nature, if you're an energetic person, you want to hire people who act like you, and that's not always the right pathway to do this. And I think a lot of job interviews are skewed. I have a lot of things that happen with that, Albert. That's a really good question. Ross says inflation is high and sticky in services and will never go down. People buy less goods and use more services. Inflation is a sucker punch. And this is the tricky part too. And this is one of the things the Fed is trying to get under control, to Ross's point. Take a look at this chart. So we had inflation from 2020 to 2022 doing this kind of a thing. It is. And you're looking at this thing, it's almost parabolic. The way that it was increasing at this level. And then poof, we start raising rates. And look at the slope of this line. The slope of this line drops to a much more moderate level. And I guess my point about inflation is it's not that it has been a steady decline. It's really a tale of two different paradigms. Of high rates and low rates. And when low rates happen, when they rose rates, we reach this new level. And the hard part is whether the hard unanswered question is whether the Fed raised rates enough to definitively conquer inflation. And I believe that they have. Some economists, some very well-known economists, thought they incidentally went too far. I think that's not the case for hurting inflation at this point. But we do have this situation. We do have this upward trajectory that is still steeper than the Fed would like it. 3 and 4% inflation is not ideal. It is the Fed has a dual mandate. They target full employment. They target 2% inflation. So they want to get inflation down to about the 2% level. And the Fed is waiting. They know shelter costs are falling off a bit, but there is issue involving some of these service sector issues. As Ross pointed out, these things are going to continue to be issues going forward, and they're going to plague the Fed. And so when we ask the question, where are my cuts when it comes down to this? And this is a screen that's grabbed from Bloomberg, the Bloomberg terminal on April 10th. And the Fed went on April 9th traders priced in basically a 53% chance that the Fed was going to cut rates in June. After the Fed came out and said, hey, guess what? Inflation is too higher than expected, and we're going to keep rates at this high as long as needed. As after Jerome Powell said this, traders now priced in only an 18% chance that the Federal Reserve will cut rates in June. And that's possibly true. I'd be very surprised if the Federal Reserve did cut rates in June because of the inflation numbers that we're seeing. The downside is if inflation remains at the 3 to 4% level, Fed doesn't cut, rates remain higher for longer. On the good news, though, it hopefully would allow longer rates over the long run, would allow finally, hopefully, greater adjustment to real estate and asset prices in ways that will bring it down to more affordable levels. But that is, again, a pie in the sky, depending on if people actually offer these for sale. Albert says, so Ross says, oh, good. Oh, gosh, I got to go back here. All right. Aaron says, let me put this way. A real question for older workers, if minimum wage keeps going up over 20, older employees become a stronger option as they just want the job, much higher loyalty. Exactly right. And I think that market in particular, as you point out, Aaron, is going to be highly desirable for a bunch of different companies in this area. And combined with the fact that there is just a wealth of evidence to suggest that on average, people underinvest for retirement. A lot of retirees are looking for those jobs. Healthcare expenses are incredibly high. And even on Medicare and other things like this, there are things people have to watch out for. And as a consequence, and adjusting to a retirement lifestyle and not having that income is one of the hardest transitions people do. In particular. Ross says rate cuts June and after election interference. Maybe that's interesting. So this is a question that we had as well involving this. Now, the Federal Reserve, and this is a question that I had about this question, Ross, so I appreciate that. Given the two possible outcomes of the election in November, how might the economy be affected by the election of either candidate? We'll talk about both candidates' policies coming up in like a couple of slides. But in this particular issue, I would say that the Federal Reserve is chartered to be independent. Yes, the Federal Reserve chair is confirmed by Congress, but the Fed operates, hypothetically speaking, in an independent manner. They don't seek an election. They don't try to manipulate things in that favor. It would be a stunning loss of credibility for the Fed to engage in that sort of manipulation directly in racketeering. They are motivated by economic improvement, even if they are successful or not successful in doing so. And the markets as a whole believe this, which is why we believe the Fed ourselves to be credible. And I'm not saying that anyone hasn't thought that, nor who knows what crosses Jerome Powell's mind. And then I want to get into, actually, and this is a question that came up. We haven't looked at the Big Mac index in some time. And the Big Mac index, sorry about that, had to turn on the light. Sun sets early out here at 106 degrees west. But the Big Mac index is one of a interesting oddities of the contemporary economic world. And what the Big Mac index does is it tries to figure out if currencies are trading at fair values or not. And so it picks a good that's available basically anywhere, which is the Big Mac. You can pick up a hamburger anywhere you go. And right now, a hamburger in the United States a Big Mac costs about $5.69. So how does that compare to other places in the world? So in Switzerland, it costs about 7.1 Swiss francs. That implies an exchange rate of about 1.25. In reality, the exchange rate is 0.87. Which means that the Swiss franc, in other words, is 44% overvalued from where it should be, based on the Big Mac prices alone. Norway, overvalued currency, net exporter of oil, current account surplus. All of this leads to a situation where it can maintain, an overvalued currency basically forever. Undervalued currency. You've got a lot of East Asia. You've got Ukraine. You've got Malaysia, Egypt, South Africa, India, Indonesia, and Taiwan, incidentally. Based on my new contacts in Taiwan, for instance, it costs about 75 Taiwanese dollars to buy a Big Mac, and it's about $5.69 in the United States. That implies an exchange rate of 13.18. But in reality, the actual exchange rate is 31.35, which means the Taiwanese dollar is incredibly undervalued. So basically, and actually, let me put this out here. 75 Taiwanese dollars is about $2.30. So if you're thinking like a finance person here, you're thinking arbitrage time. Let's charter a vessel called the SS Albert. Let's sail it to Taipei. Just fill the hold with as many Big Macs as we can. And then, of course, bring it across the Pacific and sell them in San Francisco at a huge potential price and just a huge potential profit for us. That's how arbitrage works in the market. You buy the low undervalued good and you sell it where it's sell it where it's more expensive. So an idea for you all, grab one of those boats, go to Taiwan, fill it up with Big Macs, bring it back, hope that it keeps well, and then resell them. What an opportunity. So I had another question too about this, and that's, well, Aaron says Powell isn't the only vote on the FOMC. That's right. He has not produced the only vote, Aaron, and that's right. And one of the issues, and I had gosh, once I brought in one of the number two people at one of the regional Federal Reserve banks, Aaron, to speak to us in my PhD cohort. And really interesting guy, really interesting conversation. And each of so the United States is divided into 12 different Federal Reserve districts, and a certain number of them are part of this open market committee. And at any given time, and often they're political appointees in the head of each district. And so you've got like these like toiling in the mines economists working under them, calculating data, doing numbers. And then you had like this person who's like in charge of the federal bank. And this number two guy was staying to me and said, hey, every time I was giving this presentation, and I know who it is, but I'm gonna, small world and all. I don't want to, alienate a Federal Reserve director somewhere. But the director of the regional Federal Reserve Bank was just asleep during most of the meetings that he gave. And so he'd be like, we need to do this, this, and this. And then they would be just off in dreamland, dreaming of whatever. And they're the one who votes on what the FOMC actually does. And so to your point, Aaron, I don't know if that makes it better or worse than Powell himself being the only or not only vote. Albert says, I'm thinking maybe you buy a Big Mac in Egypt and sell it in Switzerland. Oh, yeah, that's right. Good point. So maybe we have a better transportation cost by the Egypt-Switzerland route. I think that's pretty smart. Anybody else suggest an arbitrage theory for us to pursue? Aaron says, Silver Thursday, Hunt cornering the silver market, Albert Monday cornering the Big Mac market. Albert controls all of the world's Big Macs at any given time. That's the final evolution of Albert's list. The fastest and slowest growing U.S. industries. Someone asked us this, so I went to IBIS World. These are the 10 fastest growing industries in the United States and the 10 fastest declining industries in the United States based on 2024 to 2025 revenue growth. So where are we making money? It's fruit and nut farming. And if you've got some solar panels on that fruit and nut farm, you're doing well. So if you're down there at the Alberts List Fruit and Nut Farm in Paso, Paso Robles, or down somewhere else, it is the place to be. Online gambling services are doing quite well. EVs are doing, although not as well as recently. And I'm going to take a deep dive into some of these numbers. 10 fastest declining industries in the United States. Unmanned aerial vehicle manufacturing in the US. Chicken egg production. You remember we had an issue involving an avian flu that took the lives of many chickens that used for eggs, and egg prices increased. Production soared back in eggs to bring egg prices back to normal. But demand is such right now that they're actually starting to cut back in chicken egg production. Wedding planners are dropping about 10% in revenues. And we're seeing, even though prices have remained high, oil in general has seen a quite decline across the board in some of their investments. Albert says wedding planners are interesting. Could we attribute that to fewer weddings being planned because it costs so much to get married? That's true. I mean, when you look at these things, I don't know how much, when I got married back a million years ago, and my wedding expenditures, I made a 318% profit on my wedding. And as a finance professor, that is one of the greatest sources of pride that I can do. And yes, my wife was, that's, it was a good enough wedding, but you have to plan it. It's all about, making everything out of cardboard and cutting costs wherever you can, including wedding planners. I imagine most people right now, when you're suffering from questions about where you get married and how you get married, or the look at the exorbitant price for a large wedding, you think to yourself, do I need to spend it on this, or can I do something else? And always worth the cost benefit. Still married after 5,000 decades, after 13, 14 years. And I'm so fortunate, so lucky. But again, you can make good money that way. Aaron says the new FTX will be called ABX Albert's Big Mac X when the DOJ charges us for RICO cornering the global Big Mac market. Goodness gracious. They can send me 25 years to life and feed me Big Macs every day in the slammer, says Albert. Oh God, I like the conversations always go one way or another in these Albert's List conversations, and you always learn a lot, even if you just follow along. So another question about this, and this is interesting, some things about inflation. Uh, right now, and I want to reiterate some things. So I question about, is this supply chain issues? It is no longer supply chain issues. Supply chains have straightened themselves out. There are areas of the market, though, that are facing a high amount of demand and in their own way, very tight conditions in their capacity to handle certain economic activity like transportation. I think inflation itself is going to be sticky. Is it going to continue to rise or not was one question we had. I think it's going to be sticky. I think it's going to continue to be sticky all year. Even if we looked at the Cleveland Fed projections from 2 years ago, even without a recession, they thought we could get back to 2% maybe in 2025. I still think that's probably pretty accurate overall. We'll have good months and we'll have bad months, and I think it'll start coming down a little bit. But energy expenses are a big question mark, and we don't know if those will continue to rise or not. We talked about rate cuts. We talked about inflation, and one of the things to worry about, especially as it pertains to tech jobs in the Bay Area, inflation itself means higher rates over the long run. Higher rates make financing more expensive. It also decreases, in all our trajectories, long-term growth rates. And one issue when we think about this, when we think about these things, it's more exciting, certainly, from a market perspective. If rates dropped again, that would produce or a more favorable environment for a lot of tech companies. And so I think it'll do better. Wow. So mortgage payments. So this is the thing as well. So another thing to think about. So let's talk a little bit about housing real quick. One thing to note, this is from Arbor Data Science. When we look at the mortgage payment as a percentage of household income, for all home buyers, it's about 24% of your household income. Do a quick calculation in your head for me as your homework. If you have a mortgage, what percent of your income that you're paying for that mortgage? Across the country, for all home buyers, it's about 24%. But first-time home buyers in particular, right now, due to the high rates that we're seeing as well as high prices, first-time home buyers are spending an average of 39% of their income on their house, which is an extraordinarily high and a very challenging number to grapple with. And then we look at this, housing affordability, now at its lowest in general because of the high rates and prices since way back in the 1980s. It has been 40 years since housing has been this unaffordable. What a time to be alive. So some other things about markets. One thing that we can observe with different markets about this, Aaron's got an idea. Markets as a whole can be very useful things to observe where people are investing money, where people are seeing growth. And things like coffee, cocoa, commodities in particular, all doing really well in month-to-date returns in April. Stuff that isn't doing well, you've got information technology, you've got real estate, all doing quite poorly, 8 or 9% declines. Fascinating questions. Aaron says, let's have a fruit and nut farm with a solar and wind farm that has frozen fruit production partnership with a Native American tribe and casino running a 3D printing and social media company. Bam! Look at that. I can hear the financing coming in, Aaron. So we got a question about the 2024 election. So the Federal Reserve is out there as an independent party, and there's a lot of questions about this. And one question that I had was a good one, and we're going to cover this more and more detail as we get closer to the election. And some of the policies espoused by the candidates become a little bit more solidified at this time. So, given two possible outcomes of the election in November, how might the economy be affected by the election of either candidate? So, this is what this slide's all about. Thank you, Albert's List question person. So, the 2024 election overall, so right now it is close, isn't it? We got Trump, we got Biden, and it is neck and neck, and we don't know which state will go which way. Like anything, no election is ever easy. It will remain uncertain, probably even after election day for some time. Who knows what will happen? But things to expect from a Biden victory. A Biden victory will mean the expiration of the Trump era Tax Cuts and Jobs Act in 2025. It would unlikely be renewed in its current form. That would raise the top marginal tax to about 39.6% from 37% where it's been. It would also have the standard deduction. So the standard deduction, you just filled out your taxes on April 15th, or maybe you had an extension. Who knows what kind of shenanigans you all are investing with, but good luck to you in this magnificent season. But the standard deduction, of course, had increased in response to this. And some of you noticed, especially if you were used to itemizing your deduction previously in taxes, that the standard deduction might have increased to a level where it made itemization no longer relevant, no longer feasible for you. You'll have to go back to it probably, unless there's some rider that incorporates that deduction going forward. I expect more and more solidified policies around student loan forgiveness. One thing that Biden has been active about has been what's called junk fees. Junk fees are everything from those overdraft fees you get in banking to renewal fees, all these other fees that exist in the banking and financial industry. And they're, they nickel and dime you, and they disproportionately affect poorer folks. And then green energy as well, I suspect we'll see continued incentives and in a market that's continually favorable for exploration in green energy. Now, a Trump victory. One thing that Trump has been touting on his trail is a 10% tariff on imports for all countries. And this is where, where populism confronts sort of mainstream economics in a very direct way. So tariffs are usually bad things in trade theory, and not always. And I know we can get into subtle details about certain aspects of trade, where you can expect that if you were to preserve an individual country's industry and certain things, tariffs can be useful, and maybe they're a guiding pathway to turn a rapid social change into a more gradual one that a society could adapt to. You can make all kinds of arguments on this, but it does expensive by general. So if we say all the goods from all the countries are 10% more expensive, those are costs that travel on to consumers. And often a lot of the products we buy don't have domestic answers for that in terms of either production quality, production cost, or availability of certain things. And so it would increase price pressures and raise prices. Whether it would able to it can preserve some industries, but what happens is, and I'll give you an example of this. One thing with tariffs that people focus on, and they say, especially if they're focused on an individual industry, if you had, for instance, a tariff on the importation of cars from other countries, or maybe just an importation of anything, Trump tariff, let's just bring it out this way. And you're doing this to protect the auto industry or the steel industry. That makes steel more expensive for places that want to buy steel. So if I'm a company that wants to buy international steel because it's cheaper, I'll do so, and I'll pass on that savings to the people that buy it. If I am a international company, or I'm not sorry, if I'm a U.S. company, and I'm in the position where I look at these tariffs as helping preserve domestic production. And I think as a U.S. steel manufacturer, this will help my business by keeping out the foreign competitors. What it in effect does is it makes steel more expensive for all the industries that need steel to operate. And we see that even when, say, 30,000 jobs are saved in the steel sector, we lose 200,000 jobs in other parts of the economy. And so it usually results in, controversially and counterintuitively sometimes, job losses rather than saving jobs in certain ways. And so that is, not something that I'm keen on in particular. Trump also supports lower taxes for higher earners, more business-friendly taxes, and enforcement policies. And this can be a mixed bag, and it might be a more friendly business environment for many businesses across the U.S. More traditional energy policy in the sense that less focused on green energy, more focused on say, oil and gas production. One thing that is the big variable in a Trump victory is geopolitical uncertainty. The Trump factor, certainly, with regards to the nature of anything that could happen, be it from Taiwan, be it to the Middle East, view it to other places, no one really knows what Trump presidency would bring to geopolitics or how those views would alter the U.S. economy. And so both both potential victories have their pluses and downsides depending on where you're coming from. But at least in the express policies of Trump, the 10% tariff bothers me the most from an economic perspective. But again, I don't like to delve too much in politics as to influence you in some way. How would RFK Jr. do, Albert? That's you know what? That's a great question. What am I doing? Not considering the third party candidate here in this position as a potential victor. Gosh, who knows? I'm just crazy pants. So other questions people had. I like Vermin Supreme's economic policy. Vermin Supreme, one of the most unheralded, often heralded, periodically heralded candidates in history. So Sean Riley asked me, I don't know if Sean's here today. He might not be. He asked me about the equity risk premium. So the equity risk premium, for those of you who are new to the finance space, is the idea that that stocks earn or are expected to generate higher returns in general than bonds. And usually over the long run, it's around 5 or 6% in the United States. And one question is why it's so high. Why do people put such a premium on equities versus bonds? And I do believe fundamentally it is based in the risk return analysis of how we work. Because stocks are riskier, because unlike a bond where, even if a company fails, you might get a negotiated settlement, stocks are truly a riskier endeavor. And that risk capital is something that is highly valued. And whether it should be 5 or 6% or 2 or 3%, as some folks argue, is a subjective question. So it's a very interesting idea, but I think it's about right because it varies country to country. Riskier countries with less certain rule of law. Venezuela, for instance, has an equity risk premium of about 26%, incidentally. And that's a fascinating question. Ross says, thoughts on investing in 2-year CDT bills and lock in for 5.5? That's a really good question. So one of the things I'm not currently a registered investment advisor, so I can't give you individual data on that. I would say, though, to Ross about that question on a 5.5 2-year, I know a lot of people who have very nicely laddered bond securities, and the 2-year is a sweet spot for a lot of reasons. I serve on a board of the Museum of New Mexico Foundation. I serve on a few boards, but in this one, we manage the endowment for a bunch of museums here in Santa Fe. And the tendency has been to look at the 2-year as a solid lock-in. And I think most portfolio managers are of that mindset because it's about the right sweet spot in terms of time and risk. Aaron says we need 26% across the board tax for corporate capital gains, personal income, only deductions on the first 30K. Wow, what an interesting idea that is, Aaron. Across the board tax for corporate capital gains and personal income, 26%. So that's interesting. So remember, what was it? Yeah, Kane in the 999 plan. And now you've got like the 26, 26, 26 plan. That's pretty good. That's impressive. I'd actually like to run a study. That's fascinating. I do think simplification might be better for people to understand the sort of nefarious and multi-sided tax issue. Aaron says, number one reason to get a PhD in econ is you get on 50 boards. I have a terminal. That's not a good reason, though. I mean, at the same time, everybody wants something, and you always end up being the treasurer. I have a terminal failure at masters in econ, and I'm on 6 boards. I know, gosh, I feel you, Aaron. I'm on so many boards, and you shouldn't be on more than, gosh, you have to say no to things. I was asked to be president of a board, and I said no because I don't have time. And then another board that runs a much bigger fund. There's a lot of things happening, but I'm very honored. It's always honored to be at the table. That's good. I don't know how to join. Why don't I put Albert on these boards instead? Albert, I would love to defer board membership to you. Aaron's got a board for you. So this is good. Question 2. Are part-time or full-time work growing or declining? Part-time workers are up right now. Full-time is down, and that's interesting. I love this question because I thought of the answer to the question in my head, and I thought of what I expected the answer would be, and it was slightly different. So I'm actually really grateful for the person in particular who asked this question. Part-time workers are increasing. This is the chart at the right. This is the number of part-time workers in millions. We're up to 29 million. You can see this is soaring. Almost a million more part-time workers than we had last month, in fact, across the country. Meanwhile, full-time workers were seeing steadiness, and it's hard to interpret this right now. Is it because participation is slightly up, people who are not in the job market are coming back to work because they see opportunity? Is it that people who want to work full-time are not being fully employed in the way they want to? Is the U6 number, for instance, are they being underemployed? Is it a mixture of these factors? And all of these could be real questions. Yes, Albert says, by the way, speaking of low income, Dr. White, what is your take on the decline of 99-cent stores, Dollar Generals, Dollar Family stores? Don't these places usually thrive? Yes, and there's been some issue with those specific things. The Dollar General, and actually the merger in particular was a particular issue with that. Let me grab you some data here. Dollar General went out and they bought 323 Family Dollar stores back in 2017. And they're like, this thing is going to be good for us and economies of scale, and it just makes sense. But they were run so differently that a lot of the issues with Family Dollar and Dollar General deal with the different work cultures, and just mergers can go towards the avenue of synergies where 2 + 2 = 5 and they create something bigger, or they can be 2 + 2 = 3 and they produce something that doesn't really work right or look right in this situation. And that's what happened there. And in the same time, dealing with higher costs, dealing with inflation. Across many rural areas of the country, those stores operate as mini Walmarts, and they're still highly essential areas to get groceries and other goods. And so it's a really interesting question of what's going to happen to the folks who live in these areas. Aaron says we need the breakdown of part-time by gender, age, prior U6. I like that. Maybe we can do a deep dive. Ross says, is part-time equals gig worker? It's a good question. That depends. And the answer is how the survey is filled out on how you consider yourself part-time or not. Aaron says all those discount stores ran themselves into the dirt. And that's true. Oh, yes. Gosh, he did. John Oliver did do that on this. It's on my list. I'm running behind on John Oliver, but that's absolutely right. So part-time is up, full-time is down. What are some macro methods for lower-income people to insulate themselves from the effects of inflation? This is tricky. Right now, the one good news for lower-income folks is that lower-income folks spend the highest percentage of their income relative to other income groups on stuff like food. And so as a consequence, when food prices are not increasing as much as they have been, this is good news. And they start, we're only up 1.1% across all the last year for food at home, which bodes well for lower income folks. Apart from that, it comes down to questions about they are very exposed to changes in inflation because of different things. And one thing in particular, and I can't reiterate this enough, auto insurance is such a big hammer to a lot of people's pockets right now, with a 20% increase in the last year. That's eating into the bottom line of many people, because a car is essential in much of the country to get around. And so as a consequence, that's a very hard thing to deal with. And anything I advise, if I was looking at the perspective of a low-income worker, would seem oddly patronizing or condescending in certain ways. And, coming from, having been at one point in my life low income as well, It is a situation that I think is um, you are very much at the mercy of the economy in ways that often higher income people forget. And so that's a challenging question. Apart from making decisions on challenging living quarters and looking at options that might rely on whether or not you have access to public transportation, it's a very tough position to be in. Do shop, and I think everyone in that position understands that. That's really tough. That's the toughest part. Albert says, the food isn't elastic. The rise in food costs and fast food wages should encourage more people to eat at home. That's true. Eating at home is a way to get things done cheaper. Ross says insurance lobby is hard at work to deflect the billions in premiums. That's true. Julie says a laughable amount of beef, meat in a burrito versus 3 pounds of brisket in Instant Pot. That's right. I love that, Julie. That's actually hilarious. A laughable amount of meat in a burrito. That's going to be the title of my autobiography. Versus 3 pounds brisket in an Instant Pot. I know. I love Instant Pots. I have an Instant Pot, and it's amazing. So Julie, cheers. Aaron, discount grocery stores, they are rocking. Pros 9.99, Ranch 99. A bunch of the other ones are still doing okay on that regard. And that's why I think that it's not chronic to this sector, to Aaron's point. Albert says, regarding insurance, I've been calling all my insurers and telling them I will pay the minimum. Insurance is not there to help you, but damned if you do, damned if you don't. All my insurers. Albert, why are you calling us? I'm just telling you I'm only going to pay the minimum. Okay. Is there something that can be done about forced inelasticity about the insurance industry? Is there something we can do about forced inelasticity of the insurance industry? That's true. The fun part is, I was talking years ago, I had actually considered becoming an actuary. And I found that process of developing mathematical models to model risk fascinating, right? And so when you think about the history of the insurance agency, we've got Nicholas Bare Bones produced the first fire insurance office, the brother of the guy from the Bare Bones Parliament. After the fire of London in 1666. We've got Lloyd's of London starting as conversations in a coffee house. Lloyd's was a coffee house between traders of these traders who would go overseas, and they were working on ways to insure ships as they went abroad. Insurance has always been a cagey, cluttery cabal of an industry, is what I'm saying. And it has been that way since its inception in the 1600s. And the amazing part about this is, and that's true, when you think about the elasticity of this thing, risk pricing models, the way their calculations work, everything is actuarial, everything is based on some reasoning, right? And so the reason that prices are going up is because the liabilities or perceived liabilities are going up, either coming from real data or anticipated liabilities from things like, everything, not just from the injury itself, but medical expenses rising, court costs rising, settlement costs rising. All of that in turn, in our very litigious society, contributes to insurance. So we're broken in this dimension because we're broken in health and we're broken in legal as well. Because we're broken across many dimensions, it's breaking here. And that's what you're feeling. And that's the answer to this. So it's not just one thing, it's many different pieces of the United States that have cost issues. One thing, I'll leave you on this actually, one thing to talk about, especially as we look at this. If you're familiar with this, look it up. Not familiar with this, look up Baumol's cost disease, Baumol, cost disease. And this is an important topic that we can discuss, but this is the idea that we have some industries where productivity has increased a lot, like, for instance, the tech industry. But we have some industries where productivity has increased very little or not at all, things like healthcare or education. But despite the fact that productivity has rose very little in these areas, the wages have come up considerably and the costs have come up considerably in these areas. And the most simplified way of explaining that to you is, imagine, you're a manager and you quit your retail job with no increase in productivity for a higher paid job in a productivity increasing automotive industry. You leave that manager space open in retail. Retail, to compete for workers in this space, has to raise their wages. And as a consequence, even though the tech industry or the automobile industry or manufacturing has become more productive, education and healthcare and government also have to raise wages as well. Almost cost disease. Take a look at it, learn it, befriend it. It is a fascinating tale from William Baumol, invented 60 years ago, and it's relevant for a lot of costs today. Ah, Aaron with the link. Bless this, bless your heart, Aaron. That's just delightful. Albert, maybe Albert's List should sell job search insurance. How much would you pay? I like how Albert, I like your look at Albert's comments. First, he's like, what can we do about the forced inelasticity? How can we make this better? And then Albert's like, can the insurance industry be disrupted? And then he arrives at the stunning conclusion, maybe Albert's List should sell job search insurance. This was a journey you've taken us on, Albert. Can we fix this? Can we? Should I just sell my own insurance? And this is how Albert became the most diabolical insurer of the unemployed. His career pathway. And then he goes across the street and buys Alex Trebek's horse. Double jeopardy. Is anybody? That is it. Just a quick thing on data for San Francisco and San Jose. Thank you for sticking around. Unemployment rates, which surged in January in the Bay Area, fortunately have settled. It is almost identical to where we were last month, which is actually a pretty good sign. And we have some good news on the horizon. We're seeing non-farm wages in San Francisco, although March unemployment data hasn't been fully tabulated by the Bureau of Labor Statistics as of this morning. We have seen some positive news in the Bay Area that some of the job attrition that we were seeing in January and February has leveled off, and we've gained a few of those jobs back, although it's nothing significant to report on. A little bit in government, a little bit in manufacturing, but still continued decline in information in both in San Francisco and a flatlined information sector in San Jose. All right, it's taken enough time. You've stuck around for an hour and a half. Thank you so much for dealing with this magical adventure. It's been great to talk to everybody here. Gosh, what did I miss? Any other questions? What do we got?
No other questions, but I think given just the nature of where everything is and where it's gone, and I know we're over time here, and thank you for staying, is what is your, I guess, advice, insight for job seekers who I think at this point are probably just trying, it's a war of attrition between unemployment and the ones who want to be employed. And it's like, so, it's almost like, how much longer will this go? Will the beatings continue until morale improves? And while the beatings continue, how do you sustain yourself?
It's a great question, Albert. In the mean run, I think that at least the trajectory, the rate of job losses that we've seen has leveled off, and that's the good news. And now it's about reskilling, upskilling, networking, making sure you have the right platform to go to the next job you're going to head to. Do it confidently, do it willingly, and if it takes you outside of California, and if it brings you back to California, consider what's on the table and what's best for you. Don't desist. Keep trying, trying, trying. And do network, do get second opinions, and write damn good cover letters whenever you can, because that can differentiate you from the pack.
Gotcha. Okay. All right. That's wonderful. And what, use AI for those cover letters? Because who reads
Oh yeah,
cover letters, right?
ChatGPT, please write a personalized story about my life, and please add the following things. Yes, tell a complete fabrication. Yes,
Yeah.
number one winner, all-time chess champion in Utah in 1988. No, I don't know what.
Yeah.
Just make it up. Is that true? No, I've never lived in Utah.
One of our watchers also says that fractional jobs are up, right? So I feel like over the last year and a half, I've seen a lot of fractional CMOs, fractional product managers, and so forth, where it's almost like you've become your own agency with this really, really specialized job. So I think that's really interesting too.
We should do a deep dive into that, actually, Albert. That's been a
Yeah, let's do
fascinating
it.
development that we've seen recently. And,
Hmm.
functional executives, for instance, across the board, we've seen that in a lot of industries. And I think that's going to be, and it's interesting, too early to tell if this will be a permanent factor in this, but let me look into this a little bit more, see what research is on it. And that's something
Yeah,
we can talk for next time.
cool. Colin, do you have any final thoughts?
I guess like I kind of missed asking this previously, but how long does it take for the effects of layoffs to really hit the company and the market. So for example, Tesla just had their mass layoffs. Um, and then I imagine there's going to be downstream effects of that. So is there like any studies or research on when, the time lag of that
Yeah.
effect, wherein I hope the companies will be like, oh no, we cut off too much, so we should probably start hiring. So like
That
we can kind
depends.
of do a ballpark guesstimate on when okay, these companies that just did layoffs, they'll hire in like 6 months or 9 months, or is it 2 years? So like are there any studies regarding that?
That's a great question, Colin. I have to look at studies in particular on that. I will say though, gosh, and what you point out is interesting. So the question is, when you think of perception, is it good or bad, or how markets perceive it? A lot of times, markets may perceive layoffs announced by companies with an immediate stock benefit. The company was bloated, the CEO comes in, it changes, they make this drastic change in hiring, and as a consequence, investors reward this because they've been asking for this for some time. And that's not something where you see somebody come back often and say, oh, we made a mistake. For companies like Tesla occupying these spaces, you're dealing with a company that is making necessary cost concerns for not fulfilling the growth promises they previously made to investors. And then the timeline on this becomes questionable. For Tesla, it's demonstrating whether or not these job losses can convert into a more efficient structure that allows them to meet or improve their sales guidelines. And the only way, fundamentally, that they'll be judged upon is whether the business is better 6 months from now, a year from now, or 2 years from now than it is right now. And that answer is different across the board for each company. And that is a really, really, really good and very nuanced question. And I appreciate it.
All right. But the answer was we don't really know.
No, I said it depends. That's right. For Tesla specifically, so here's what's
Yeah.
going to happen. So if Tesla has a good quarter coming up or two good
Uh-huh.
quarters, it'll be the Elon Musk is a genius and these people needed to go. If it is continues its slide, and it can't meet growth expectations, the onus will fall back on the CEO then to explain themselves with that respect. So the results, the ends will justify the means with regards to the nature of
And I
this sort
would
of.
think that Elon is
Yeah.
hoping for the Google, Meta, Salesforce bump that all those three respective companies got, where earnings just absolutely soared. And but I mean, I guess that also depends on how you see Tesla, because some people like Robert Scoble will tell you that Tesla is a software company and an AI company, whereas maybe your regular Joe will tell you that Tesla is an automotive company that just happens to make that just happens to make an electric car. So I think it really depends on which side you analyze it from.
Mhm.
Yeah.
For sure.
Uh, yeah.
Great. This has been great, and great links too from Aaron in the here as well if you want to check out some stuff on auto insurance. They've been fun to read.
Yep. Yep. Cool. And then Ross finally says, I fear the AI implementations will slow down rehiring after the current spate of layoffs. I can see that too. Yeah. Aaron says it's the worst. Tesla is the worst as a software company that has the worst CapEx model in history. Yeah, I mean, I think Tesla faces numerous headwinds, right? Cheap Chinese EVs, a CEO who wants to maximize free speech and has become politically inclined and is really alienating his more left-wing EV buyers for right-wing non-EV buyers, which is fascinating to watch. Plus just the fact that demand is slowing down. And you also have an upcoming infrastructure challenge too, where, are you going to have enough electricity to really just say between like, are you going to power EVs? Are you going to power those AI data centers? Or are you going to power the lights inside of people's homes so that they can sit around their dinner table and eat? And one of those three doesn't make money. This is the final one. So, I think that'll be a very fascinating debate in the next couple of years. So, yeah. All right.
Yeah.
Well, Dr. White, do you have any final thoughts? We'll conclude right after that.
Thank you all so much for coming and hanging in there extra long. I really do appreciate all of you, and you guys are a fantastic audience. Go on, go forth, get great jobs, and keep rocking and rolling. And we appreciate. Thank you for making our economic growth so positive.
And there you have it. My name is Albert. I am your host of Albert's List with my co-host, Dr. Riley White of the University of New Mexico, and Colin Moe, moderator at Albert's List. This video will be available on YouTube later tonight or tomorrow, and you can watch out for the upcoming event that we'll do again for this webinar sometime in May. Until next time, thank you so much for watching. We have many more events that you can take part in, including events happening tomorrow and next week. Best of luck in your job search, and we will talk to you all soon. Goodbye, everybody.